Imagine buying a stunning €1 million apartment in the absolute center of Bordeaux.
Oh, the dream.
Right. You get the keys, you walk onto this beautiful wrought iron balcony, you look down at the gleaming cobblestones, a little corner cafe. You are literally living the cinematic French dream.
A postcard brought to life.
Exactly, a
Yeah.
total postcard. But then a few weeks later, you get a formal letter from the French government.
Never a fun letter to get.
No, definitely not. And this letter informs you that it is legally, completely illegal to rent this property out. No rental income allowed.
Right.
You can't even raise the rent on the current tenant. You are now holding this massively expensive, entirely illiquid asset that produces nothing but a tax bill. And it's all because of an environmental law you didn't even know existed.
Yeah, and the crazy part is, it is a scenario that is playing out with shocking frequency right now.
Really? That
Yeah.
often?
Oh, absolutely. Foreign investors fly in, they completely fall in love with the aesthetics of, 18th century limestone, and they just completely ignore the fact that the 2026 French property market is an entirely different beast than it was even 3 years ago.
Right.
The aesthetic appeal of France hasn't changed, obviously, but the mechanical, the legal, and especially the financial scaffolding underneath it, it has been completely re-engineered.
Which is exactly our mission for this exploration today. We are basically tearing down that postcard. We want to provide you with the ultimate insider's playbook for the Bordeaux real estate market as it stands right now in 2026.
It's so needed.
We are decoding the tectonic neighborhood shifts. We're going to break down those incredibly rigid new environmental regulations that are catching so many people off guard. We'll navigate the legendary maze of French taxes and, most importantly, outline the exact execution a foreign buyer needs to follow to avoid a spectacularly costly disaster.
Because, look, the opportunities to build generational wealth in this city are absolutely still there.
Right, it's not all doom and gloom.
It's not at all. Bordeaux remains one of the most dynamic, desirable urban centers in Europe. But the margin for error, particularly for someone trying to execute this from thousands of miles away, is just slimmer than it has been in a decade.
Yeah.
You can no longer just, throw a dart at a map of the historic center and expect to print money.
Okay, before we begin, a quick reminder that this is an educational exploration. This is not financial advice. We don't know your personal situation, and you should always do your own research before making any property or investment decisions.
Always.
So, setting the stage here. Before we look at specific streets or charming little balconies, we have to understand the structural integrity of the city itself. Are we looking at a sinking ship or a rising tide? Let's get into the macro picture.
Yeah, to understand where we are sitting in early 2026, you really have to look at the storm we just navigated.
The post-COVID hangover?
It's exactly. For years leading up to the post-COVID era, Bordeaux was on this spectacular, almost dizzying upward trajectory. The city had undergone massive revitalization. They spent decades cleaning the black soot off the historic facades, installing the tramway, pedestrianizing the center.
It became gorgeous.
It did, and capital flooded in, especially from Paris. But then, post-COVID, inflation hit. The European Central Bank spiked interest rates, and the market went through a severe, but honestly entirely necessary correction.
The fever finally broke. Buyers who thought the line only went up suddenly found themselves staring at a completely frozen market.
Yeah, the volume of transactions just plummeted because the cost of borrowing tripled in a matter of 18 months.
Which is terrifying.
It was. But the data shows that the market officially bottomed out in early 2025.
Okay, so last year.
Right. At that absolute floor, the bleeding stopped. We were looking at average citywide prices hitting roughly €4,407 per square meter. That was the point where sellers simply refused to drop their prices any further. The standoff reached its equilibrium.
And looking at the dashboards today, where has that equilibrium settled? Where are we now?
The market has stabilized and even clawed back some ground. We are currently seeing prices hovering comfortably around €4,550 to €4,600 per square meter on average.
Okay, so a bit of a bounce back.
Yeah, we have climbed out of the trough. Now, we are nowhere near the frantic, over-leveraged peak pricing of 2022, but the trajectory is undeniably solidifying.
So for you, the person listening to this and looking to actually deploy capital, what does this environment represent? Is this a fire sale? Are there absolute steals out there just waiting to be scooped up?
Well, I wouldn't call it a fire sale. It is what we would classify as a highly rational, buyer-friendly market.
Rational being the key word there.
Exactly. The distinction is critical.
Mm.
You are not going to walk into a pristine, fully renovated apartment in a prime district and demand 20% off the asking price. Sellers of quality assets are holding incredibly firm.
Because they know what they have.
Right. They know the intrinsic value. However, you do have leverage now. You have the time to conduct thorough due diligence, the time to bring in contractors for quotes, and the space to negotiate terms.
Which was literally impossible during the boom.
Oh, completely impossible.
Yeah.
Back then, properties sold sight unseen in 4 hours.
Yeah, the desperation is gone, replaced by calculated negotiation. And I have to imagine the primary reason that standoff ended is because the banks finally stopped moving the goalposts.
The interest rate whiplash was terrifying for retail buyers. But today, mortgage rates in France have settled into a manageable, predictable range, typically between 3.5% and 3.8% for a standard 20-year fixed loan.
Which is pretty reasonable.
It is. When borrowing costs stabilize at a figure that people can actually plug into an Excel spreadsheet without fear of it changing next week, confidence returns.
So sideline buyers, the ones who paused their lives, delayed their moves, just held on to their cash, they suddenly look at the math, realize a 3.5% rate is historically quite normal, and they come back to the table.
And we see that immediately reflected in the transaction volume. Sales are up 17% compared to the previous year.
Wow. 17%.
Yeah, that is a massive injection of liquidity back into the system. The gears are turning again.
A 17% jump is literally the sound of the market unfreezing. But, okay, when you dig into the price growth data, it isn't just a rising tide lifting all boats equally, right?
Not more.
Because overall, the city's prices are up about 2% over the last 12 months. Yet there is this fascinating, massive split. Existing apartments are up 3%, houses are completely flat at 0%, and then you have new build apartments, which are skyrocketing up 7% year over year.
It's huge divergence.
Wait, I have to push back on this. Isn't the ultimate French dream to own a beautiful stone house with a garden? Why are apartments drastically outperforming the classic family house?
I know, it challenges all the conventional wisdom. But it makes perfect sense when you look at modern European economics. The sprawling house with a garden is running headfirst to the reality of maintenance costs, energy bills, and demographic shifts.
It makes me think about it like investing in the stock market.
Okay, how so?
Buying real estate in Bordeaux right now feels like the traditional houses are these stagnant legacy blue chip stocks. They are prestigious, they look great in a portfolio, but they are heavy, incredibly expensive to maintain, and the needle just isn't moving on their value. Meanwhile, the apartments are the reliable, high-yield dividend payers.
That legacy stock analogy holds up perfectly, especially when you factor in the regulatory environment.
Right, the energy laws.
Exactly. An older 150 square meter house in Bordeaux is going to require a massive, expensive energy retrofit to comply with the new climate laws. We will break down those laws shortly, but the sheer surface area of a house makes insulation, roof repairs, and heating upgrades exponentially more expensive than an apartment.
Plus the asking price.
Yeah, the absolute price tag of a house simply prices out the vast majority of domestic buyers given current interest rates.
Whereas the apartment, particularly the new build,
The new build is perfectly aligned with the demographic reality of 2026. Bordeaux is experiencing a massive influx of young professionals, smaller households, remote workers, and students.
and they don't want to mow a lawn.
Exactly. They aren't looking for a garden to maintain. They want high-speed internet. They want to be on the tram line. They want practically zero utility bills, and they want turnkey properties.
So the new builds check all those boxes.
They offer all of that, plus they're automatically compliant with the strictest environmental standards. Buyers are essentially paying that 7% premium for absolute certainty and ease of mind.
Certainty is a highly undervalued asset class, especially when you are buying across borders. And looking at the horizon, the projections for the next 5 years estimate a healthy, sustainable cumulative growth of 10% to 18% for the city overall.
Which translates to roughly 2% to 3% annually.
Very steady.
Yeah, it is a mature, disciplined growth rate. It is not the reckless 10% annual jumps of the boom years, which inevitably lead to a crash. It is solid, compound growth supported by real economic fundamentals.
So if apartments are giving you a 7% premium citywide, it's really tempting to just buy the first one you see online. But when you zoom in on Bordeaux, a 7% city average can mean 15% in one neighborhood and negative 5% in another. How drastically does the actual street dictate these returns?
Oh, the geography of opportunity in Bordeaux is incredibly nuanced. The difference of just 3 or 4 streets can fundamentally alter your investment thesis.
It's that hyper-local.
Totally. A city's not a monolith. It is a collection of hyperlocal micromarkets.
Okay, let's map it out. Let's start at the absolute peak. The premium postcard. The triangle door. The golden triangle.
Visually, the Triangle Door is breathtaking. It is bounded by the Grand Theatre, the luxury boutiques of Cour de l'Intendance, and the Grand Boulevards. It represents the architectural zenith of 18th century Bordeaux.
And the prices reflect that, I'm sure.
Oh yeah. You are looking at average prices sitting at the absolute top of the market, around 5,865 euros per square meter, and often much higher for truly exceptional properties.
But the rental yield, you're looking at a mere 3.1% gross. By the time you factor in management fees and taxes, you are barely keeping pace with inflation.
Yeah, if you are deploying capital into the Triangle Door, you must understand that you're making a heritage play, not a cash flow play. You are parking capital in a trophy asset.
Like buying fine art.
Precisely. It is a highly illiquid but historically safe store of wealth. You will attract high net worth tenants, executives, diplomats, affluent expats. They will pay their rent on time, and they will treat the property well. But the sheer cost of acquisition means the monthly math will never generate massive cash flow.
So if you want a bit more yield without sacrificing the charm, where on the map do you look?
You shift slightly outwards to the Bohemian and bourgeois districts, specifically areas like Chartrons and Saint-Cyran.
Oh, Chartrons always comes up. It's famous for the antique shops, the art galleries, the wine merchants, historically operating right on the river.
It has this incredible self-contained village feel while still being in the center of the city. Prices in Chartrons, and in the similarly elegant but slightly more residential Saint-Cyran, generally sit between 4,918 and 5,248 euros per square meter.
Still pricey, but better.
Yeah, and the structural demand there is essentially bulletproof. You have young professionals, affluent families, and remote workers who want the Bordeaux lifestyle, the Sunday markets, the cafes, without paying the absolute premium of the Golden Triangle. The yields here creep up closer to 4% or 4.5%.
But there's a fascinating phenomenon here, something I think traps a lot of international capital. The expat blind spot.
Yes, the expat blind spot is so real.
Right. Foreign buyers fly in, they walk around the historic center, they see the grand monuments, and they become entirely mesmerized. They decide they absolutely must buy an apartment overlooking a famous square. But the locals, the people who actually understand the daily rhythm and friction of the city, they have a totally different strategy.
The contrast in buying behavior is stark. Foreign buyers consistently overpay for the postcard, prioritizing walkability to tourist sites. But locals prioritize daily logistics.
Like parking.
Exactly. They look at neighborhoods like Nansouty to the south. Nansouty has incredible architectural charm. This is where you find a lot of those classic stone ACOPs. It's a bit quieter, you can actually manage to park a car, the local schools are highly rated, and the prices are much more rational.
So follow the locals.
If you want to invest smartly, you often need to look where the local professionals with families are moving, not just where the tourists are taking photos.
That makes total sense. You want to buy where the domestic economic engine is going. Which brings us to the high-growth regeneration zones. These are the areas projected to see 3% to 5% annual growth, drastically outpacing the city average. And number one on this list is a massive urban project, Atlantique.
Atlantique is currently one of the largest urban renewal projects in Europe. This encompasses the area around the Saint-Jean train station and the Belsière neighborhood.
And the catalyst is the train, right?
Yes, the entire catalyst for this multi-billion-euro regeneration is infrastructure, specifically the high-speed train.
The TGV line connecting Bordeaux to Paris in 2 hours.
When you cut the travel time between a regional capital and Paris down to 2 hours, you fundamentally alter the economic gravity of the city. Bordeaux suddenly became a viable hub for Parisian corporate capital and hybrid workers.
Because you can commute.
Exactly. You can live in Bordeaux, work from home for 3 days, and commute to Paris for 2. The municipality recognized this and has been pouring resources into redeveloping this entire corridor, building massive new office complexes, thousands of new housing units, and new public spaces.
Okay, and what's the second high-growth zone?
You have to look at the water. To the north, you have Bacalan and the Bassin Offlot, and over on the right bank of the river, La Bastide.
Which used to be pretty rough, right?
Very. Historically, these were gritty, industrial, maritime areas, warehouses, submarine pens, shipping docks. Today, they're undergoing massive waterfront transformations. The city has extended the tram lines deep into these neighborhoods, built the Cité du Vin Museum, and the property appreciation here is being directly driven by that municipal investment.
Okay, let me play devil's advocate for a second.
Go for it.
Are we absolutely sure these new regeneration areas aren't just overhyped, sterile construction sites? I mean, I've seen these zones of the future in other global cities. A developer throws up a bunch of glass towers, puts down some concrete planters, and calls it an eco-village. But they often lack the soul, the bakeries, the street life that makes Bordeaux actually desirable. Are investors just buying into a slick marketing brochure?
The skepticism is incredibly healthy and frankly warranted. You should never invest based solely on a developer's rendering. But the differentiating factor in Bordeaux's regeneration zones is the long-term compounding effect of municipal infrastructure spending.
Meaning the public transit.
Right. When the city commits to laying down a new tram line, that is a permanent structural upgrade to a neighborhood's accessibility.
A tram line isn't a marketing gimmick. It's physical steel in the ground that connects workers to jobs.
Precisely. In a city where traffic congestion can be brutal and parking is increasingly restricted, being situated on a reliable public transit artery permanently increases tenant demand.
So you have to be patient.
Yeah, so yes, a street in Bacolod might feel a bit like a construction site today, and you might have to wait a few years for the local bakery culture to fully establish itself. But you are buying the future connectivity. The data consistently shows that properties within a 5 to 10 minute walk of these new transit hubs command a 5% to 10% premium over the wider market over a 10-year horizon.
You're buying the municipal blueprint.
Exactly.
But what about the areas where the blueprint is flawed? The dark side of the map. Let's talk about the investor traps, the places you absolutely must avoid, no matter how ridiculously cheap the listing price looks. Let's start with the flood zones.
Because Bordeaux is built along the Garonne River, and the river is tidal, there are low-lying pockets, particularly in parts of Bacolod and La Bastide on the right bank, that are officially designated by the state as high-risk flood zones.
And a flood zone designation isn't just a warning that you might get wet feet once a decade during a bad storm.
No, it is a financial albatross. It means brutal, sometimes prohibitive insurance premiums. More importantly, it creates massive friction when you eventually try to resell the property.
Because buyers will know.
France has incredibly strict disclosure laws. Future buyers will see that bright red risk flag on the mandatory geological surveys provided by the notary. A cheap property in a flood zone is cheap for a very permanent reason.
Then there are the flight paths.
Specifically, the western edge of Calderon. Now, Calderon as a whole is generally a lovely, highly affluent area. It's often called the Neuilly of Bordeaux due to its large family homes and excellent schools.
But the western edge.
The western fringe sits directly under the persistent approach paths for the Bordeaux-Marignac Airport. You will suffer a permanent price discount because of the noise pollution. The commercial airlines aren't going to change their descent routes to accommodate your property value. Your asset will always have an artificial ceiling on its appreciation.
Makes sense. And the third trap is something you actually see in some of those highly praised regeneration zones, the homogeneous blocks.
This is a classic investor pitfall. In parts of Atlantique and the Bassins of Flaw, developers have built massive, sprawling blocks of essentially identical new-build apartments. They sold them off-plan, heavily to investors utilizing tax incentive schemes like the Pinal Law.
So you have a building with 50 identical two-bedroom units, all owned by absentee investors.
Yes. And what happens when the building is delivered and all 50 investors hand the keys to their property managers on the exact same day, trying to rent them out simultaneously?
It's a vicious race to the bottom. If my unit is identical to the one next door, the only lever I have to attract a tenant is dropping the rent by 50 euros.
You completely lose your pricing power. If you are buying in a new development, you always want to secure an asset that has some unique, defensible characteristic.
Like what?
A superior view, a top-floor orientation, a larger terrace, an atypical layout, something that breaks the homogeneity and prevents you from competing purely on price.
All right, so you've navigated the geography, you avoided the plains, the floods, and the clone apartments. You found the perfect, unique property on a great street. But here is where the 2026 market throws its absolute biggest curveball.
The green regulations.
Exactly. The physical condition of the bricks and mortar is now heavily, heavily policed by the government. Let's get into the green value and the regulatory reality checks.
If you take away only one thing from this entire discussion, let it be this. The French government has declared an absolute unyielding war on what they call the passoire thermique.
The thermal sieve? A building that just leaks heat in the winter and bakes in the summer.
Every single residential property in France is now legally required to have an Energy Performance Certificate, known as the DPE. It grades the property on a scale from A, which is a state-of-the-art passive house, down to G, which is
Mhm.
essentially an uninsulated stone box with single-pane windows and electric baseboard heaters.
And if you fall at the bottom of that scale?
If you own a property rated G or F, you are facing brutal structural legal restrictions.
Break down how an inspector actually assesses a thermal sieve. What are they looking for? Because they aren't just looking at your past utility bills, right?
No, the algorithm is entirely focused on the physical characteristics of the building envelope and the mechanical systems. They measure the thickness and type of insulation in the walls and the roof. They check the glazing on the windows.
So it's a very physical audit.
Very. They heavily penalize fossil fuel heating systems like old gas or oil boilers, and they reward heat pumps. They even look at the ventilation system to see if you are losing heat through air exchange. Based on these physical inputs, the software generates a theoretical energy consumption per square meter.
And if that software spits out a G or an F, what does that embargo actually look like on the ground? Like, how bad is it?
It is a systematic strangulation of the asset's yield. As of the recent waves of regulation, homes rated G or F can no longer be newly rented out to tenants. Period.
Oh, it really? Just a flat ban?
It is illegal to sign a new lease. Furthermore, even if you have an existing tenant happily living there, you are legally forbidden from increasing their rent, regardless of inflation. The government is intentionally suffocating the yield to force owners to renovate.
It's like buying a vintage Porsche. Sure, the aesthetic is beautiful, it looks incredible parked in the triangle door, but the French government is basically acting like the DMV, telling you that unless you rip out the original engine, replace the entire exhaust system, and install a hybrid battery to the tune of 40,000 euros, it is illegal to drive it off the lot. The aesthetics of the building simply do not matter if the engine is a DP rated G.
That is the exact reality. To take an F or G rated apartment and upgrade it to a legal D or C rating, you have to undertake massive structural intervention.
Right, it's not just a coat of paint.
No, you have to rip out the walls to install interior insulation, because you often cannot touch the historic stone exterior. You have to change the windows, upgrade the electrical, install a thermodynamic water heater. You are looking at a mandatory capital expenditure of anywhere from 15,000 euros for a small studio to 40,000 euros or more for a larger apartment.
Not to mention the headache of finding qualified contractors, artisans with the proper environmental certifications, in a market where everyone is trying to renovate at the exact same time, which explains perfectly why those new builds we talked about earlier are surging in value by 7%.
Exactly. Investors are running the math. They look at the 40,000 euro renovation bill, the 6 months of dealing with French contractors, navigating the permits from the historic architectural review boards, and they're saying, no, thank you.
Yeah, I'll take the easy route.
Right. They say,
Okay.
I will just pay a 7% premium upfront for a new build that is already graded an A or B and is guaranteed to be legally rentable for the next 30 years. Consequently, we are seeing massive discounts on older, poorly rated stock.
Which creates an opportunity.
Oh, a massive one. Mom and pop owners who cannot afford the eco-renovations are dumping their properties on the market. For a sophisticated investor who already has a reliable renovation team in place, buying a deeply discounted G-rated property, upgrading it, and capturing the forced depreciation is where the real value-add opportunity lies today.
But the energy laws aren't the only regulations cracking down on landlords. We have to talk about the war on short-term rentals, the STRs.
Yes, the era of the Airbnb model acting as an unregulated free-for-all is dead in Bordeaux. The municipality, facing a severe housing shortage for local residents, has clamped down aggressively on platforms offering nightly rentals.
How aggressive are we talking? Because a lot of international buyers build their entire financial model assuming they can rent the place out for 250 nights a year at premium tourist rates.
If that is your model, delete the spreadsheet.
Just throw it out.
Throw it away. If the property is your officially declared primary residence, you are hard-capped by law at exactly 90 rental days per year. The city software integrates with the rental platforms. They enforce it automatically. Once you hit 90 days, your calendar is blocked.
Wow.
And if it is a secondary residence and investment property, you are required to obtain a change of use authorization from the city, legally shifting the property from residential to commercial tourist use.
And I'm guessing the city isn't just handing those out to anyone who asks.
In a housing shortage, the city is incredibly reluctant, and in many central districts outright refuses to grant them. The regulatory friction is simply too high. The smart money in 2026 has executed a complete pivot. Investors must shift their strategy to mid to long-term rentals.
What does that pivot actually look like in practice? What are the lease structures?
It looks like three distinct, legally protected pathways. First, you have the bail mobilité, or mobility lease. This is a highly flexible 1 to 10-month lease, specifically designed for students, interns, or professionals on temporary corporate assignment.
Okay, so a nice middle ground.
It offers great flexibility, you can furnish it beautifully, and you avoid the regulatory nightmare of nightly tourist rentals. Second, you have the standard furnished rental, which requires a 1-year lease commitment, renewable. And third, the traditional unfurnished rental, which under French law requires a 3-year minimum commitment to the tenant.
The yields on a 1-year lease might be slightly lower on paper than a hypothetical fully booked Airbnb, but the certainty is much, much higher. You aren't paying for daily cleaning, you aren't dealing with tourists losing the keys at 2 a.m., and you are 100% legally compliant.
You're swapping theoretical maximum yield for durable, legally compliant, and financeable reality.
Okay, so you've bought an eco-friendly C-rated apartment in a high-growth neighborhood like your Atlantique. You've got your long-term professional tenant secured on a furnished lease. Now the notorious French tax system enters the chat. Let's demystify the labyrinth, because France has a terrifying reputation when it comes to taxes.
The reputation for high taxes is largely earned. However, the fear comes from a lack of understanding. When you actually break the French tax code down into its component parts, it becomes predictable and highly manageable. It just requires extremely precise navigation and choosing the right legal structures from day one.
Let's start with just owning the physical building, the property ownership taxes.
There are two main pillars of property tax in France. First is the taxe foncière. This is the fundamental land and building tax.
No.
It is paid annually by whoever owns the property on January 1st of that year, regardless of whether the property is rented out or empty.
Okay.
And importantly, your taxe foncière bill almost always includes a line item called the TIOM.
The TM, what does that stand for?
Taxe d'enlèvement des ordures ménagères. It is the municipal waste collection tax. The crucial thing for investors to know is that while the owner pays the overarching taxe foncière, the law allows you to claw back the TIOM portion from your tenant as they are the ones actually producing the garbage.
Oh, that's good to know. And the second pillar.
The taxe d'habitation. Now, there is great news here. After years of political reform, this tax was completely abolished for primary residences. If you live in the property as your main home, you do not pay it.
But there is always a but when we talk about tax relief.
But if this is your second home, a vacation home, or an investment property, you absolutely still pay it. Furthermore, if you just leave the property sitting completely empty in a zone designated as having a housing shortage, which includes all of Bordeaux, you'll be hit with the TLV.
The TLV, the vacant property surcharge.
Taxe sur les logements vacants. This isn't just a slap on the wrist, it's a punitive tax that starts at 17% of the theoretical rental value in the first year and jumps to 34% in subsequent years.
Do they really want you renting it out?
The government is literally taxing you on the phantom rent you could be making, specifically to force hoarders and absentee owners to put inventory back on the rental market.
Use it, rent it, or pay heavily for the privilege of keeping it empty.
Precisely. Although, to give you a tiny bit of good news, the French TV license tax, the CAP, which used to be attached to the taxe d'habitation if you owned a television, was completely scrapped a few years ago.
Hey, we will take the small victories. Okay, let's move to the real meat of the matter. Taxes on rental income. How badly am I getting hit when my tenant transfers the rent into my account every month?
If you are a non-resident of France, the baseline is a flat 20% income tax on your first roughly 29,000 euros of net rental income. Anything above that threshold is taxed at 30%.
A flat 20% doesn't sound terrible compared to top marginal income tax brackets in other countries.
That is just the income tax. Then, France applies a 17.2% social charge on top of it.
Bah! There is the pain. So we were looking at nearly 40% combined.
Yes. However, there is a massive, highly beneficial carve-out for residents of the European Union or the UK. Because of specific international treaties and the fact that you are already affiliated with the social security system in your home country, that 17.2% social charge drops all the way down to a mere 7.5% solidarity tax.
That is a massive difference in your net operating yield if you live in London or Madrid versus living in New York or Sydney. Okay, so how do I actually calculate the taxable amount? I know France has different regimes for declaring income.
There are two main pathways, and choosing the right one is critical to your profitability. The first is the microfoncier or micro BIC, depending on if it's furnished. Let's look at unfurnished under microfoncier. This is the simplified, low paperwork route.
Sounds appealing.
It is. If your gross rental income is under 15,000 euros a year, you can elect this regime. The government simply gives you an automatic, flat 30% tax-free allowance. You don't deduct your actual expenses. You just pay tax on 70% of the gross rent.
Clean, easy. You don't need an accountant to track every single receipt for a light bulb. But what is the alternative if I have high expenses?
The alternative is the regime réel, the real income and expenditure method. Here, you deduct your actual, real-world expenses from your gross rent. We are talking about property management fees, landlord insurance, your taxe foncière, the interest on your French mortgage, the cost of repairs, and critically, if you rent the property furnished, you can deduct the depreciation of the asset and the furniture over time.
So let's play this out. If I have a heavy mortgage and I just spent 30,000 euros upgrading the energy rating from a G to a C, I absolutely want the regime rail because I can write all of those massive expenses and the depreciation off against my rental income, potentially reducing my taxable rental profit to absolute zero for years.
Exactly. The microfoncier is designed for administrative simplicity. The regime réel is designed for sophisticated tax optimization. A good accountant will run the projections for both and tell you which one minimizes your burden.
Now, we have to talk about the boogeyman that terrifies international capital, the wealth tax, the IFI.
The impôt sur la fortune immobilière. It does strike fear into the hearts of foreign investors, but mostly because they misunderstand it. It only applies to a very specific subset of high net worth buyers.
Break it down for me. What actually triggers the wealth tax?
First, context is important. President Macron changed the old wealth tax, the ISF, into the IFI, specifically to encourage investment in businesses. The IFI now only applies to real estate assets.
Oh, really?
Yeah, it completely ignores your stock portfolio, your cash in the bank, your business assets, your art collection. It only looks at real estate. And the trigger threshold is 1.3 million euros in net real estate wealth.
Net meaning the value of the property minus the outstanding mortgage debt attached to it. So if I buy a 2 million euro building, but I have a 1 million euro mortgage on it, my net asset is only 1 million. I am under the threshold.
Correct. The debt acts as a shield. But here is the tricky, somewhat punitive part of the math. Once your net real estate wealth crosses that 1.3 million trigger threshold, they don't just tax you on the amount above 1.3 million.
What do they do?
The formula actually reaches backward and starts calculating the tax from 800,000 euros upwards. The progressive rates start at 0.5% and scale up to 1.5% for massive portfolios.
Ouch. That retroactive calculation stings. But I understand there is an incredible loophole for expats who are actually moving to France to live.
It is less a loophole and more a deliberately rolled out red carpet to attract wealthy expatriates. If you officially relocate and become a primary tax resident of France, the government grants you a 5-year grace period where your global real estate assets located outside of France are completely exempt from the wealth tax calculation.
That's huge.
They will only look at the real estate you own inside French borders for the first 5 years.
Yep. That gives you half a decade to structure your affairs, sell off overseas properties if needed, or plan your estate before the global net drops. That is incredibly generous. Finally, let's talk about the exit strategy. You've held the property, it's appreciated, and you want to sell. Capital gains tax.
If you sell an investment property for a profit, you face a flat 19% capital gains tax, plus the 17.2% social charges.
So roughly 36% combined. That feels steep right off the bat.
It does, until you understand the tapering system. France actively, aggressively rewards you for holding the asset. The longer you own the property, the larger your discount on the tax.
How long do you have to hold it?
After the 5th year of ownership, the tax starts dropping every single year. After 22 years of ownership, your capital gains tax obligation drops to absolute zero. And after 30 years, the social taxes drop to zero as well.
You know, I have to push back on France's reputation here. When you actually lay all the cards on the table, the 5-year wealth tax grace period for new residents, the capital gains tapering down to zero over time, the ability to write off massive eco-renovations under the regime réel, it doesn't feel like a tax hell at all.
Right.
It feels like the French government is just heavily rewarding patient, long-term capital that improves the housing stock while heavily punishing quick, speculative day trading flippers.
That is the perfect synthesis of the entire system. If you try to day trade French real estate, buy it, slap some paint on it, and flip it in 12 months, the transaction costs and the tax system will absolutely crush your margins. But if
Right.
you buy a solid asset, improve its energy efficiency, place a reliable tenant in it, and hold it for a generation, the tax system is incredibly accommodating. It is a system designed for durability, not velocity.
Okay, so the intellectual strategy makes perfect sense. The macroeconomics are sound, the geography is mapped out, the environmental laws are understood, and the taxes are known. But executing this master plan from 5,000 miles away, this is where the wheels usually fall off for foreign investors. Let's talk about execution and overcoming the major obstacles.
Executing a cross-border real estate transaction is an entirely different sport than buying a house in your hometown. There are 5 major structural obstacles that foreign buyers inevitably crash into if they try to do it alone.
Obstacle number 1, the language and the bureaucracy.
This is not just about having enough high school French to order a croissant. You are dealing with complex legal frameworks.
Mm.
France operates on a civil law system vastly different from common law.
Yeah, you have the notaire.
Exactly. You're dealing with a notaire who isn't just a lawyer, but a state-appointed official who collects taxes and ensures the legal sanctity of the deed. You have to open a mandatory French bank account to facilitate the wire transfers, which requires navigating intense anti-money laundering compliance. The legal language of a French compromis de vente, the preliminary sales agreement, is dense even for a native speaker.
No.
For a foreigner, it is impenetrable.
Obstacle number 2, impossible logistics.
Think about the timeline of buying property locally. A local buyer in Bordeaux might visit 15 properties over 3 or 4 weekends before feeling confident enough to make an offer. If you live in Sydney or Chicago, you might fly to France once a year. You cannot physically perform the necessary due diligence.
And photos lie.
Buying off internet photos is a guaranteed way to buy someone else's problem. You don't smell the dampness, you don't hear the traffic, you don't see the crack in the facade.
Obstacle number 3, mortgage discrimination.
French retail banks are inherently conservative institutions, and their algorithms view non-residents as high-risk anomalies. While a local French buyer with a steady domestic job might walk into their local branch and secure a 3.3% interest rate, a foreign buyer will often face rates between 4.5% and 5.5%.
If they even give you the loan at all.
Assuming the bank even agrees to look at their dossier, yes. The banks demand mountains of translated certified paperwork to prove your foreign income, and they often misunderstand foreign tax returns.
Obstacle number 4 is remote tax compliance, which we just covered, navigating the filing of your French returns from abroad without making an error that triggers an audit. And finally, obstacle number 5, the wrong property trap.
This is the lack of localized data. Paying 350,000 euros for an apartment that is only worth 300,000 because France doesn't have an open Zillow-style MLS system where you can easily see every comparable sale on the street. Or buying into an area that looks charming on Google Street View but is secretly slated by the municipality to become a massive industrial logistics hub in 2 years.
So how do you solve this? Because going into the French property market alone as a foreigner is like representing yourself in a foreign court. You don't know the penal code, you don't speak the dialect, and the prosecution plays this game every single day.
The solution, and frankly, the only viable, sane method for a remote buyer is hiring a real estate hunter, a chasseur immobilier.
A hunter, not an agent. This is a crucial distinction that doesn't really exist in a lot of Anglo-Saxon markets, where one agent can represent both sides. Explain the difference.
In France, a traditional real estate agent holds a mandat de vente. They are hired by the seller. Their absolute fiduciary duty is to get the highest possible price for the seller while disclosing only the bare legal minimum.
So they aren't working for you.
Not at all. A real estate hunter holds a mandat de recherche. They are retained exclusively by the buyer. They do not sell property. They source it from all agencies, off-market networks, and private sellers. They represent your financial interests and your interests alone.
What exactly are they doing on the ground while I'm sitting in my living room in another time zone?
They are acting as your proxy. They do the physical visits. They walk through the property on a live video call with you, actively looking for flaws. They point out the damp spot on the ceiling, the noisy street corner, or the structural crack that mysteriously didn't make it into the glossy listing photos.
That's invaluable.
And it goes beyond that. They review the HOA meeting minutes to see if a massive roof assessment is coming. They coordinate the notary, translating the legal jargon into plain English. And crucially, they have established relationships with expat-friendly banks and private mortgage brokers who know how to underwrite foreign income.
Let's ground this in reality with some concrete case studies from the field. Let's talk about Marcus, a buyer from the USA looking to invest in Bordeaux. Walk me through his actual timeline.
Marcus was based in San Francisco. He had identified 8 potential properties online that looked fantastic on paper. Instead of flying over blindly and spending his vacation running between appointments, he dispatched his hunter. The hunter physically visited all 8 properties over a few days. They recorded detailed video reports, checked the neighborhood dynamics at different times of day, and immediately eliminated 5 of the 8 properties.
Why were they eliminated? What did Marcus miss from San Francisco?
One of them, located in Carteron, had photos taken at 10 a.m. But the hunter discovered that by 3 p.m., commercial jets on the western flight path were rattling the windows every 14 minutes. The hunter literally stood in the living room on FaceTime and held the phone up to the ceiling so Marcus could hear the noise.
Oh, wow.
Yeah. Another property had a beautiful historic facade, but the hunter read the recent co-ownership minutes and found out the building was facing a €60,000 mandatory facade restoration order from the city.
Which saved Marcus from flying 6,000 miles to look at absolute duds, or worse, actually buying one.
Exactly. Marcus flew in for just 1 week to physically inspect the final, highly curated shortlist of 3 properties. He made his choice. The hunter negotiated the price down by 8% to reflect fair market value based on unlisted comparable sales data, and they closed the deal. The hunter transformed a chaotic, multi-month logistical nightmare into a highly efficient 1-week surgical strike.
And what about someone looking for pure, hands-off passive yield? Let's look at Michael from Australia.
Michael never even set foot in France during the process. He bought completely remotely. He wanted an investment property in Bordeaux to diversify his portfolio, but managing it from Sydney with the massive time zone difference seemed impossible.
Right.
His hunter sourced a prime, legally compliant rental unit for €280,000. They handled the entire notarial signing process via legal power of attorney. And then crucially, the hunter connected Michael with a vetted, local, bilingual property management firm. Michael now earns a 3.8% gross yield completely passively. His rent hits his account while he sleeps on the other side of the planet.
That is the ultimate power of delegating to local experts. And the hunters don't just find the property and manage the logistics. They can actually save you serious money on the financing, right? Like the case of Sandra and Jorge from Spain.
Sandra and Jorge wanted to buy a property near Toulouse. They are self-employed business owners in Spain. To a French retail bank, foreign self-employment income is treated like toxic waste.
Really? Toxic waste?
Yes, it doesn't fit into their neat, salaried boxes. Their finances were complex. If they had walked into a standard French bank branch off the street, they would have been instantly rejected. But their hunter packaged their financial dossier beautifully, translated the business accounts, and leveraged their professional network of brokers to present the file to an underwriter who specializes in expatriate lending.
And didn't the hunter actually negotiate a discount on the interest rate?
They secured a 0.5% discount off the standard non-resident rate because the hunter brought the bank volume business. Over the life of Sandra and Jorge's loan, that 0.5% saved them roughly €20,000 in interest payments.
Which completely covers the professional fee of hiring the hunter in the first place. It reinforces my point. Going into a foreign market, a real estate hunter isn't an added luxury expense. They are a structural insurance policy against your own ignorance. They literally pay for themselves in avoided mistakes, negotiated discounts, and optimized financing.
Absolutely. If you are investing hundreds of thousands of euros in a foreign, highly regulated jurisdiction, trying to save a 2% or 3% agency fee by doing it yourself is the absolute definition of stepping over dollars to pick up pennies. The mistakes you make will cost you 10 times that fee.
It's pure false economy. All right, let's pull all of this together. We have covered an immense amount of ground today. We established that the Bordeaux market in 2026 has successfully navigated its post-COVID correction. It is no longer a market of blind optimism where you can buy any property and watch it appreciate. It is a market of disciplined, mathematical underwriting.
This exactly. The foundational lesson here is that success in France requires looking past the romantic postcard. It requires respecting the DPE energy laws and ruthlessly factoring those €40,000 renovation costs into your initial acquisition price. It requires playing the long game with the French tax system to benefit from the capital gains tapering and the wealth tax grace periods, and most importantly, it requires utilizing on-the-ground fiduciary expertise to execute the transaction safely and efficiently.
It's about being strategic, not just enthusiastic. Which brings us to a final, lingering thought for you to ponder long after this audio stops playing. We've talked deeply about energy grades and legal restrictions. As cities globally, not just Bordeaux, but everywhere, crack down on tourists, restrict short-term rentals, and enforce increasingly brutal climate efficiency laws to hit their carbon targets, what if the true future of global real estate isn't about owning the most central, historic, postcard-perfect property? What if the real wealth is built by owning the most adaptable property, a space that can survive shifting zoning laws, shifting climates, and still remain undeniably desirable to the local workforce?
It is the profound shift from investing purely in heritage to investing in resilience. That is where the actual durable wealth of the next decade will be built.
Thank you for joining us. This is the French Real Estate Insider Podcast.